What is going on, my friends? Ryan Williams here, back with another one, and in today's video I'm going to be doing a deep dive into my dividend stock watch list, and we'll share with you guys which stocks I really want to add to my portfolio, why I want to add them, and also why I have not created positions in any of these stocks just quite yet. Anyway, before we get rocking and rolling, give this video a big thumbs up if you guys are excited to talk about some dividend stocks today, and also leave me a comment below. Let me know which stocks are currently sitting on your watch list. I would be curious to hear if we have any of the same ones. Anyway, thank you so much for doing that, and also thank you guys so much for the continued support you show to me in my channel. It is so cool to see these videos getting so much love, and it's even cooler to be interacting with so many of you guys in the comment section. So keep it up. You guys are doing awesome. I really appreciate it. Anyway, enough rambling on my part, guys, and now, without further ado, let's get into it. All right, guys, now the very first stock I want to talk about today, and the first one on my watch list, is Best Buy, ticker symbol BBY. Now, I was first shown this stock by my boy Zaldath, who hit me up in the DMs one day on Instagram talking about Best Buy. And he says, got into Best Buy just in time, it looks like. Bought in on Friday, yesterday, and this morning. Those earnings are quickly taking away my discount. The only thing I don't love is the inconsistent dividend. The numbers make the dividend look safe, but it just seems like the business is so cyclical and they aren't really concerned with the sustainability of the dividend. He goes on to say a few more things about Best Buy and then finishes it by saying, anyway, I think it's worth a deeper dive if that sounds appealing to you. So first of all, my man, thank you so much for the recommendation. We've actually had some really good chats in the DM, so I'm thankful for that. And from what I've seen, I also really like the numbers. So let's just kind of run through it just a little bit so you guys can see kind of what I see about this stock. So for starters, let's just take a look at the price history, guys. In the last year, it's really not up too much, only up 5.44%. Year to date, it's up 11.22%. Last 6 months, about 4%, and then in the last month, it's actually down over 3%. So you can see it's kind of going down a little bit. And looking here, guys, it looks like, I mean, back on August 24th, so really not too long ago, it was sitting at about $10 more per share than where it's currently at, and it's done nothing but go down since then. And if we move over here and look at the PE ratio, we can see that it's really not priced too expensive right now. A PE ratio of 11.5, which is pretty good, indicates some affordability. And let's scroll down a little bit here. See how the revenue's growing. So for the most part, guys, just across the years, Best Buy seems to just do more in revenue than the previous year. The only exception is what's estimated for 2023, which I'm not sure why it is estimated to be less than 2022. But other than that, revenue just seems to go up and up for Best Buy. And keep in mind, these are just estimates and really don't reflect what's actually going to happen with the company. They could, you know, actually continue to increase revenue, and this estimate could be off. We'll see what happens. And then if we jump over to this value page, let's take a look at a little bit more of the affordability. So scrolling down, okay, the price to book sitting somewhere in the 6s, both in the trailing 12 months and the forward price to book. So that's a little bit high, but the price to cash flow, at least the forward price to cash flow, is really not too bad, in the single digits, which is really where we want it. So that kind of reflects the same thing that the PE ratio shows, that Best Buy is still, you know, in the affordable range, at least for now. And if we jump over to the dividends, guys, scroll down a little bit, the dividend's not too terrible. Okay, 2.5% dividend yield, which is pretty average. A payout ratio that's pretty low, 29%, which means they really have some room to grow this dividend if they wanted to. And it looks like they have 5-year growth rate of almost 20%. Okay, and then 7 years of consecutive dividend growth, which it'd be nice to see that a little bit longer, but we'll see how things play out. They could continue to grow it as the years go on. I would guess, going back to this real quick, I would guess that with this payout ratio so low, that the dividend growth could be sustainable. That's just kind of my thought at a glance. Could be wrong on that, I don't know. And let's jump over to the dividend history. So despite 7 years of consecutive dividend growth, they have been paying their dividend for the last 17 straight years, which is good. And then scrolling up, I want to look at one more thing with Best Buy. Let's look at this growth page real quick and scroll down, guys. So I just want to look at the revenue real quick. Revenue, at least across the last 5 years, has really gone up. Okay, growth of 5% compounded for the last 5 years, or almost 6%, I mean. Across the last 3 years, about 6.5%. And then year over year, they've seen a 20.36% revenue gain, which is nice. The one thing that is a little bit concerning is seeing this levered free cash flow decreasing. I mean, 1 year, if the levered free cash flow takes a hit, that's not the end of the world. But across the last 3 years and 5 years, seeing this be a trend, that's not the most comforting thing, especially as it pertains to the dividend, because the free cash flow is what they use to pay the dividend. So if that's not increasing over time, the likelihood of the dividend continuing to grow or even continuing to be paid is you know, the chances of that happening kind of decrease. And that's one of the reasons Best Buy is still on my watch list. Add to the fact that I really don't need to add another consumer discretionary stock to my portfolio right now. And as you guys will see as we go on in this video, I actually have a handful of more consumer discretionary stocks on my watch list. So this one may not be my first choice when it comes to adding to consumer discretionary stocks, but I don't want to spoil the rest of the video. Let's move on to the next stock on my watch list. All right, guys, this next one, number 2, is Lockheed Martin, ticker symbol LMT. Now, if you guys saw in my last video, I was talking about an industrial stock that I was considering adding to my portfolio. Well, this is that one. And fun fact, I actually, when I first started dividend investing, I used to have Lockheed Martin for like a minute. I really didn't have it too long. I don't remember exactly why I initially sold out of it, but it is a stock that I'm looking to add back into my portfolio, which I'll explain why more in just a moment. But I want to give some credit here real quick. This stock was brought back to my attention by my good friend Johan Lorenzo, who also has a YouTube channel where he talks about stocks and investing and trading options and stuff like that. Really good content. I've actually learned a lot from watching his videos, and he's a really cool dude too. I think you guys, if you like my videos, you'll enjoy watching his videos, so definitely check out his channel. I'll include a link to it in the description of this video for you guys to make it easy to find. But he hit me up in the DMs and he said, dude, opened a position with LMT today, finally. Got a solid 5 shares. The dang stock is above $372 per share. Their dividend is growing at a very fast rate, and they have a great payout ratio, 40%. Their sales have been steadily growing year over year since 2014, just giving you a heads up. And we've had a couple more exchanges about Lockheed Martin since then, and I know he's just been dumping a ton of money into that stock, which rightfully so. It looks like it's at a pretty good discount right now, which is one of the reasons I have it sitting on my watch list, is because I want to see how it's going to continue to perform, because right now, as you guys can see from this chart here, it's on a kind of a downward trend. In the last year, it's down about 7.5%. In the last 6 months, it's actually up a little bit. But then in the last month, just in the last 30 days, guys, it's down another almost 3%. And when him and I were first talking about it, this was probably back at the end of July. So it's been about a month and a half since this stock first came back on my radar. And I'm kind of glad I've held off on it, because it does seem to get a little bit cheaper as time goes on, which means I think it would be a good stock to dollar cost average my way into. And it's one that I'm considering adding to my portfolio once I'm done building up my position of Intel, which, as you guys probably already know if you've been watching my videos, is my primary goal right now. But anyway, getting into Lockheed Martin a little bit more, for those of you who don't know what it is an aerospace and defense company, and they work pretty much 100% with the government, making planes and missiles and rockets and stuff like that. They make a lot of really cool things and are dealing with some really advanced technology. And scrolling down just a little bit more, guys, one of the cool things about Lockheed Martin, and one of the things that makes it such a good investment, is look at this revenue just going up and up and up and up and up. It just does not stop increasing year over year. It's a really important company, and at least the government, relies a lot on it. And that is a good thing, but it also could be a bad thing. And to elaborate on that a little bit more, I'll read from this article that I recently read on Seeking Alpha. And the article reads, as Lockheed Martin has almost 100% government exposure, there is no way to escape a declining trend in defense spending, especially not considered that Lockheed produces some of the most important aircraft of the armed forces. So, based on that, investors will have to trust that defense spending remains in a long-term uptrend, and that Lockheed will be in a position to satisfy the demand for advanced weapons and related systems. So that little snippet pretty much just hit the nail on the head. To invest in this company, you have to have faith that defense spending is going to continue to increase as time goes on, which then amplifies the importance of companies like Lockheed Martin, which thus makes it a good investment over the long term, if that turns out to be the case. Like I said, it could be a bad thing that this company relies 100% on government contracts and government spending. You just never know what could happen, especially as it relates to what's going on in Washington, D.C. And we don't have to go any deeper on that, guys. It is just something to mention because it is somewhat relevant to this company. Let's move on and talk about the dividends for LMT real quick. Switching over to the dividends scorecard page. Scrolling down, you can see the dividend yield. It's close to 3%, 2.96%. And just like Johan said, the payout ratio is at a pretty sweet spot, just under 40% now. A 5-year growth rate that is pretty pretty nice, okay? 9.52% growth rate, and then a dividend growth history of 2 years, which is not the longest, but if we switch over to this dividend history page, we can see that they have been paying their dividends consistently for the last 26 years. So seeing that is a bit reassuring, guys. At least they have a good history of paying their dividends, and hopefully they'll continue to increase them as time goes on. I think the payout ratio, just like with what we saw with Best Buy, the first company we talked about, is low enough that they have room to continue growing this dividend, but we'll see what happens. And then jumping over to the value page, guys, I don't remember if we've touched on the PE ratio or not, but the PE ratio for the trailing 12 months is 13.67, and the forward PE ratio is 13.10, so it is coming down a little bit. And scrolling down, we can see they have a forward price to book of 11.86, which does not indicate any affordability, and then a price to cash flow, which is above 10, 11.78, kind of right where that price to book is, which is not ideal either. So it seems that this company still has some room to come down. And so kind of my approach to this stock as it pertains to getting it off of my watch list and into my portfolio is I'm just gonna keep watching it. I'm just gonna keep seeing what happens, seeing if it continues to go down in price, maybe over the next month and a half. By that time, I should be where I want to be with Intel, and I might be ready to add another stock to my portfolio. But as of now, guys, this one is definitely a top contender for the next stocks that I'm gonna be adding to my portfolio. This could be lucky number 20, guys, the 20th stock I add to my portfolio, but we'll see what happens, because you know, a lot can happen between now and the next month or the next 2 months. And I have some other pretty good stocks on my watch list. So let's move on and talk about the third stock on my watch list. All right, guys, now this one, we are looking at another consumer discretionary stock. The third stock on my watch list here is Lowe's, ticker symbol LOW. And this one has been on my watch list for some time. Okay, this is a good company to own. It's a dividend king, which is the biggest reason that it's in my portfolio. But kind of my beef with Lowe's, I think it's a little bit expensive right now. I don't know that I want to buy into this company at this time. And the reason being, let's just look at this price history. In the last year, it's up 32%, or almost 33%. Okay, in the last 6 months, up 25%. In the last month, it's up a whopping 7.33%. So this stock is really skyrocketing. And for me, I think it's kind of out of the buy range. So I'm gonna keep this one on my watch list for now, but nonetheless, I think it's a really good company to invest in, a really good long-term hold for you dividend investors out there. And scrolling down, guys, let's take a look at their revenue. So just like with what we saw with Lockheed Martin, this one just does nothing but go up in revenue, okay? In January 2022, or by then, they're estimated to do almost $93 billion in revenue. That is a buttload of money. And then the next year, they're anticipated to do 1 billion more. So guys, they're taking in a lot of money. They're doing really well. And it's a company that's been around for a long time. They were founded in 1921, so they've been around 100 years. And then scrolling down here, guys, they also just crush their earnings estimates every single quarter, at least for the last 5 quarters, which is all we can see here. And then scrolling up, as I mentioned, they have a really good dividend, so let's take a look at that. Scrolling down here, we can see that Lowe's has a current dividend yield of 1.57, a payout ratio that's really low. We've seen some really low payout ratios today, but a payout ratio that's really low, below 30%, a 5-year growth rate that is substantially high, right up there with Best Buy, 16.92%, and then a dividend growth history of 58 consecutive years. It is very impressive to see this growth rate so high considering how many years of dividend growth that they have. That is awesome. I'm really stoked on these dividend stats. I wish the yield was a little bit higher, but you know, I think there's a little bit of a trade-off. I'll take a lower yield for a higher rate of growth. That's fine for me, especially considering how much longer I have to invest. I can be patient and let that yield on cost grow over time. More than anything, I'm impressed to see how many years of dividend growth they have. That really alludes to the reliability and sustainability of this dividend and the importance they place on paying it and growing it as well. So this is the kind of stocks you want in your portfolio, guys. All right, now moving on to stock number 4 in my watch list. I want this stock so bad, guys. Microsoft, ticker symbol MSFT. Like I just said, I really have been dying to add this stock to my portfolio. I really wanted to buy into this one over Intel, but Intel was just at too much of a discount to pass up, and Microsoft, in my opinion, is the complete opposite. If you're looking for value, it is so the wrong time to buy Microsoft, which is the only reason that it is still sitting on my watch list. And just to run through its price history, in the last year, it's up nearly 50%. In the last 6 months, it's up just over 30%, 32%. And in the last month, it's up about 3.7%. And this is the most expensive stock we have looked at today in terms of the PE ratio, currently sitting at 34.15, which is way out of the acceptable buy range for a lot of dividend investors. And for those of you who have not seen my recent video on how to analyze dividend stocks for beginners, an acceptable PE ratio, or a PE ratio that lets us consider like a stock to be in the affordable range, is probably about 20 and below. And the PE ratio of Microsoft right now is almost double that. Okay, 34.15. Definitely not at a value, and you'll hear everyone say that Microsoft is just so overpriced. But the thing about Microsoft, and one of the things I go back and forth on is, yes, it's very expensive right now, but guys, just based on the price history, it does nothing but go up. Microsoft just performs really, really well. Okay, if you're looking for a stock that's going to appreciate in value, this is a really good one to have. And then scrolling down, let's just take a look at their revenue, guys. This is unbelievable. Unbelievable. Look at this slope. This is the best revenue growth slope we've seen all day. Like between 2021 and 2022, they're estimated to do over 23 billion more dollars in revenue. And from 2022 to 2023, what is that? Another $24 billion gain in revenue? That is just insane, guys. Really insane. There's no stop in Microsoft. And that's what makes me think, like, is it worth just biting the bullet? And even though it's, you know, kind of expensive, is it worth it just to buy into it? Because it really does just go up and up and up. Let's move on and talk about the dividend of Microsoft real quick. Out of all the stocks we've looked at today, it has the lowest yield. Most technology stocks are not known for their dividend yield. Apple has a really low dividend yield as well. Microsoft, 0.75% dividend yield with a also low payout ratio with room to grow, 25.48%. A 5-year growth rate that's pretty sweet, 9.24%. And then 11 years of consecutive dividend growth, which I like to see. And if we go over to the dividend history page, we can see that they've just been paying their dividend for 17 consecutive years, which is also really good to see. So in general with Microsoft, guys, it's going to remain on my watch list at least for the foreseeable future. The deeper that I get into this dividend investing stuff, and the more that I learn, and the more that I talk to you guys in the comment section, the more that I realize the importance of buying stock at a value. Because while it is important to buy high quality stocks and high quality companies that you can count on over the long run, it's also really important to buy stocks at a discount, or buy them really like as cheap as you can, because the ones that are cheaper to buy right now are going to be the ones that have more upside potential, generally speaking. And with that said, I still think that there's value out there to be found in the stock market. Intel's a really good example. AbbVie right now is a really good example in my opinion. Campbell's Soup, I know some of you guys are, you know, hit or miss with Campbell's, but that's another one that's at a real discount right now. AT&T is another one that's also priced at a pretty good value. So there's other stocks that are going to be better to buy right now that I think have more upside potential, that aren't going to be as, I mean, I don't want to say overpriced, but priced as expensive as Microsoft is right now. All right, guys, now moving on. Stock number 4 on my watch list is Target, ticker symbol TGT. Now, there's a couple reasons that I have this on my watch list, or that I'm considering buying into this company. First and foremost, I am a big fan of Target. I go there quite frequently. I'd say probably at least once a week. So I'm a frequent shopper at Target. It's a company that I know. It's a company that I believe in. It's a company that I spend a lot of time and over time have spent a lot of money at. And they say you should invest in companies that you use, and this is one of those for me for sure. And number 2, Target's just a good company and it's a good stock to invest in, which we'll talk on more right now. So just looking at the price history, okay, in the last year, it's really done a number, guys. It is up almost 71%, which is just blowing my mind, okay? And then in the last 6 months, it's also done really well, up nearly 40%. In the last month, though, it's down about 5.5%, 5.4%, okay? So it is coming down just a little bit. And the PE ratio is getting up there as well, guys, currently sitting at 18.95, but still under that 20. You know, that 20 is kind of the cutoff between being affordable and being, you know, too expensive to buy, generally speaking. So it is kind of hovering around that line. And so, you know, you may be able to get away with buying into it right now, especially when it's down 5.4% in the last month. It's still got a little bit of ways before it reaches the top of its 52-week range. But scrolling down, guys, just looking at Target's revenue, it's kind of similar to what we saw with Microsoft. Maybe not, you know, as steep of a slope, but the same story. It just goes up and up in revenue as time goes on, especially between 2020 and 2021. Look how much more they did in revenue between those years. And even 2021 going into 2022, it looks like they're really making a jump. So this is a company that continues to grow, evolve, and expand. And that is really what you're looking for in a long-term investment. And then just jumping over to the dividends, guys, for Target, scrolling down, I really do like these dividend stats. It reminds me a lot of Lowe's, actually. The yield's not too high. The payout ratio is in a pretty good spot where there's some room to grow. You know, it's less than 30%. 15%. The 5-year growth rate is not as high as some of the other stocks we've seen today, but the dividend is reliable and I think it's here to stay for a long time. At least that's what history shows with this stock, as they have a consecutive dividend growth of 53 years, making this the second dividend king that we have talked about today. And I'll tell you what, when I first looked at this stock, I did not expect to see it be a dividend king. I did not expect this many years of dividend growth. I didn't even know Target had been around as long as it had. If we look here, we can see that it was founded in 1902. That is something I was not aware of at all. And kind of to close out the conversation on Target, guys, the reason that it's still in my watch list, just like with Lowe's and just like with Best Buy, I'm not 100% sure that I want to add another consumer discretionary stock to my portfolio right now, but I can say this with a fair amount of certainty. Out of the three that we've talked about today, Best Buy, Lowe's, and Target, Target is probably my favorite out of the bunch, okay? Target is probably the one that I am most likely to add to my portfolio as far as consumer discretionary stocks goes. And it pairs well with my other consumer discretionary stock that I currently have, which is Starbucks. As a lot of you guys probably know, there are Starbucks in a lot of Target. So the two kind of go hand in hand and complement each other well, and would do so in my portfolio. All right, guys, now the last stock that is on my watch list is one that you guys have heard me talk about a handful of times, and that is VICI Properties, ticker symbol VICI. For those of you who are not familiar with this stock or with this company, VICI is an experiential REIT, and they own different buildings, very iconic buildings like Caesar's Palace in Las Vegas, and they're about to pick up on a couple more, MGM Grand, and then one other one that is also owned by MGM Growth Properties. I don't remember which one, but they own a handful of buildings like that. The most popular ones, there's like 3 or 4 of them in Las Vegas, and if you guys know me, you'll know that I love the Vegas. I love the Vegas, so having this on my watch list is pretty cool. I would love to someday invest in this company and get involved in something that I'm excited about, which is Las Vegas. I love being there. So if I can invest in any portion of that, I'd be excited too. But the reason this stock is currently in my watch list and not actually in my portfolio is because I am already too heavily weighted into real estate, too heavily weighted into REITs. I currently have Realty Income, ticker symbol O, and WP Carry, ticker symbol WPC, and those combined make up about 13% of my total portfolio, and I'd like my real estate allocation to be a little bit lower than that, maybe about 11%. So I'm kind of working on buying other things right now, building other sectors out, and hopefully that real estate allocation will come down and I can, you know, squeeze one more in there and hopefully have that one more be VICI. And this is actually a relatively newer company too, guys. I think if we scroll down, we can see that they were founded, in 2016. So they've only been around for about 4 or 5 years, but in that time, they've really skyrocketed as far as sales go and revenue goes. So back in 2016, their first year, or probably first portion of a year, they did $18.8 million in revenue, and then their first full year they did $201 million. But then, you know, fast forward to December 2020, they did, what is that, 6 times more than that or so, 1.23 billion. So just in a matter of years, they've really skyrocketed their revenue and are expected to continue to do so. Just in the next couple years, they're expected to add about 600 million to this number right here. And scrolling up, guys, going over to the dividend, let's see how that is looking. So being a newer company, only being around for 4 or 5 years, they're not going to have a crazy amount of dividend growth history, and that is seen here. I mean, they've only been growing their dividend for 3 years and don't even have like a 5-year growth rate listed here. But the dividend yield on this stock is not too bad, 4.54%. That's one that I would consider high. And then as far as the payout ratio goes, 72.12%. Usually you see REITs in like the 90% range. I'm actually not sure why this payout ratio is in the 72% range. If you guys have any info on that, let me know in the comments below. But scrolling up, going back to the summary page, guys, in closing with VICI, I don't want to talk about this one too much because I feel like I've been talking about it a lot lately. The main reason, or I'd say the primary reason it is on my watch list, is just because I'm so hyped on what this company is and what they do in the buildings that they own. Like I said, I love Las Vegas. There's probably not a day that goes by that I don't at least mention Vegas once or watch a video on Las Vegas or stuff like that. I think the best way to just put it is I really love Las Vegas, and that's why this stock is on my watch list. And I know I kind of rambled about this for a minute. All right, guys, and that pretty much wraps it up for this video. Those are all of the stocks on my watch list. It's a good group of stocks, I think. I don't think I'll end up buying into every single one of those over time. But realistically, I would say the ones I'm most likely to add to my portfolio are going to be Target, Microsoft. I think someday I'll have Microsoft in my portfolio. Lockheed Martin, I definitely think I'll have that in my portfolio probably in the near future. That's looking like the next stock I'm going to be adding. I don't want to spoil it, but I want to do some more research into that one, but I really like what I'm seeing with Lockheed. And also VICI, I'm still probably a little bit of a ways out from adding that to my portfolio if I even do. I don't want to buy it just because I like Las Vegas. I don't think that's a good enough reason to buy into this company. So I'm going to chew on it, maybe see how it develops as time goes on and keep my eye on it at the very least. You know, we'll see what happens, but I'm not in any rush to buy that one. So that's about all I got for you guys for this video. Thank you so much for sticking around to the end if you are still here with me. And if you have not done so already, please don't forget to leave a thumbs up on this video. Click that like button before you move on to the next one. And also leave me a comment below. Let me know which stocks are on your watch list. I would be curious to hear what you guys are looking at and which investments you guys are considering. So leave me a comment below, let me know. And with that said, I will now get out of your guys' hair. But thank you once again so much for watching this video. I really appreciate it. Hope you guys have a great day, and I will see you in the next one.